I work for a U.S. domiciled insurance company, so we actually tend to be a little bit U.S.-centric. So most of the opportunities we continue to believe in is investing in the U.S. Obviously, our underlying portfolio companies are very much international, and if we break down some of their revenue based on geography, I would say it's a very international portfolio. But within the next 3 to 5 years, we still continue to focus on sector-based, middle-market U.S. buyout companies. Well, obviously, you're right, track record, team, but I think more importantly for us, it's always the internal operating expertise that they have in-house. A lot of the, I think you heard from today's conference, a lot of the private equity titans are talking about the model has definitely changed. You can't just buy a company, apply leverage. You really have to buy good companies, grow these companies, and eventually sell that to a larger public companies. So in doing so, you really have to have in-house expertise, whether that's certain industries that you might be specialized in, and it's important to have that expertise. So that's why part of a majority portion of our due diligence, we focus on understanding the team's background in that specialization. Well, by definition, again, distress for control. Obviously, there are distress trading-oriented strategies. Given the type of distress and risks you take on, by design, their return tend to be shorter, quicker, and IRR tends to be high, but net multiple tends to be smaller. We are a mutual company. We invest for the long term. We invest basically based on net multiples. So obviously, our focus, our bias is towards distress for control investments. But that you have to really have the stomach to weather some of the early noises. But to answer your question, distress for control is something that we still prefer.